Let's get you all to the weekend. Live from New York City this morning. Good morning, good morning. Your equity market on the week, pretty flat on the session, pushing higher on the S&P by 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the Bank of Japan shaking up the global bond market. As Lagarde oversees a stagnating German economy, Chairman Powell can point to robust growth in America. We begin with the big issue, wrapping up a central bank triple header.
It's certainly a big week.
The Fed moved 25.
The Fed and the ECB.
She's doing exactly very, very close to what Powell's doing.
They didn't want to convey accidentally anything dovish.
Being extremely cautious, being pragmatic.
All central banks have the same problem.
We were not surprised.
It was exactly on expectations.
We almost got to the end of the week with expectations for what central banks were going to do.
The BOJ with a surprise move.
The Bank of Japan are tinkerers.
The Fed and even the ECB, I think they're going to take a backseat.
Central bankers know that markets have a tendency to get carried away.
If I'm Chair Powell, I permanently have my fingers crossed behind my back.
Joining us now to discuss Amundi's Monica Defend and Morgan Stanley's Jim Caron. Monica, first to you. It's a hike from the ECB, a hike from the Federal Reserve, and a tweak to yield curve control at the BOJ. Can I just ask you how you responded this morning when you saw those headlines? Just what has the BOJ done this morning?
Well, actually, probably the Bank of Japan was the only bank yesterday that was making something different from what most of market participants were expecting. Having said that, for all the three banks, it is important to understand what comes next, because starting from the BOJ, will the central banks continue to defend the cap to 1% with unlimited purchases, or this will be breakable? And this is what I think the market is asking today.
So, Jim, do you perceive this as the starting gun on a tightening cycle, that the next step from here is maybe an interest rate hike next year? Or is this just about setting up policy in a more sustainable way to keep it easier for longer?
Yeah, listen, I think this is the first step on a very slow, long walk. So I think that what the significance here is that global bond yields have lost their anchor to some degree. We could always count on JGB yields to be relatively low and the Bank of Japan to be easy. And this is the first signal that they're going to start tightening policy. And we have to think about this as a tightening, but from the back end first. And it's almost like a LIFO, last in, first out, where yield curve control was one of the last measures that they used, and now they're starting to unwind that. So even though this is a really small tweak, and I really believe it's a tweak, it sends a really loud signal that the Bank of Japan is now going to start tightening policy, but they don't want to create like a taper tantrum, like 2013 taper tantrum, which is Ben Bernanke and the Fed and what happened there. They want to make sure it's a very, very controlled, slow leak towards higher yields and normalizing policy rates.
If you are just tuning in, the BOJ has what's called yield curve control. There's a target of 0%. There's a ceiling of 0.5%, and we're being told by the BOJ and Governor Ueda that ultimately that 0.5% ceiling is now what's called a reference point, and that they can come into the market every single day and buy 10-year yields at, say, 1%. This is what Governor Ueda had to say. The decision to tweak the YCC is not a step towards normalization, but, Mike McKee, the aim is to enhance the sustainability of the monetary easing. Now, Mike, that's what he says it is. What is it?
It is a tweak. I think Jim is right here. They are moving in the direction they want to go, which is to get rid of yield curve control. But it's going to be very difficult to do because the markets are so used to it at this point. And if they think the bank is getting out of it, they're going to be selling off. The yellow line there is where they were in 2016 after they introduced the idea of extremely low rates and yield curve control. And everything up through 10 years was below zero. Now they went to this yield curve control where they would allow the 10-year to go up by agreeing to buy at 0.5 percentage point, bring it up below zero. Now they're going to allow it at 1%. So slowly we'll see the yield curve start to creep up there. And I think that's what they want to do is move it very, very slowly. The central banks in general, you were talking about the idea of them maybe getting close to the end. The data we got from the Fed today certainly suggests that, with basically inflation moving in the right directions. And you can see how at the end of this week, with the exception of the Bank of England, the top white line there, which doesn't meet until next week, everybody has moved a little bit closer to their end point. The Fed is now just one move away if they actually get there. The Bank of Japan is within 10 basis points of doing that, and the ECB is very close as well. So by the end of this year, we could see everybody in pause mode. They seem to be getting closer and closer to that.
Mike, thank you. The latest on the central bank decisions this week: hikes from the ECB and the Federal Reserve, tweaks from the Bank of Japan overnight. Monica, you put it all together. Is that bullish or bearish for bonds right now?
Well, it should be bullish for bonds. Actually, we've been positioning more constructively on duration, both on the U.S. and on the euro curve. We think that approaching the peak, then the ECB is clearly data dependent, but even they have, also if they have 25 basis points in September, this really doesn't make a big difference at this stage. The other side of the coin will be on the risky asset. What does it mean, and whether a slowdown eventually in the economy will kick in. Eventually, we also saw very good data out of the U.S. economy with the release of the second quarter. Despite real consumption is slowing down, it is still positive, 1.6 year on year, but is slowing. So this is really something we'll need to think about to rethink the positioning along the remainder of the year.
You think the ECB and the Federal Reserve is basically done here? Jim, you take a subtly different view, I would say, a little more nuanced. You think bonds are at risk still? Jim, tell me more.
Yeah, look, I mean, I think central banks are still keeping the door wide open for rate hikes and being very, very data dependent in terms of being concerned about inflation. And if they see it, they're going to act. And one of the points that I like to make is that, for the ECB, for example, people are starting to count them out and say, look, they might have one more hike and that's it. But I kind of take a different view on that. I think the ECB, out of all the central banks, has to get the inflation problem solved. And that's because of the structural rigidities in the European labor markets. So what Europe is starting to experience right now is a small form, just the beginning stages of possibly wage price spiral inflation, meaning that you see a lot of strikes in Europe. People are getting higher wages. Companies are able to increase their prices. People get higher wages, and on and on and on. And that's a spiral. So I think that it's more likely that the ECB can overshoot. Now, to that point, and same with the Fed, I think the Fed is also very, very concerned about keeping inflation anchored. So to that point, I think that whether it's Powell or it's Lagarde at the ECB, I think that the door is still wide open for them to continue to hike interest rates. So I think front-end yields can be somewhat at risk. Curves are likely to stay inverted. Not until they start steepening will I believe that the end of the rate hiking cycle is really here.
Jim, would you expect to see some divergence between government bond markets in Europe, in the United States, based on the information you're seeing so far? The French GDP data, and we'll talk about it later, was okay. Germany's terrible. The PMIs earlier this week, not great at all. I just got this note from Bank of America, Mike Gaitman and the team, and the headline reads, "If this is a slowdown, please give us more." Because the data in America, Jim, has been pretty decent through the week. Could we get some divergence between government bond markets?
Absolutely. Look, I mean, I think that the data is even diverging to some degree. And the way that I've looked at the U.S. versus Europe since the pandemic is that the U.S. has been running about 3 or 4 months ahead of Europe in terms of the cyclical data and the turning points and central bank policy and inflation and things like that. So I think that the surge that we're seeing in the U.S. right now, this late cycle surge, Europe might actually see that too. And I also think that PMIs, particularly in the U.S., are bottoming at this point, and that they're going to move more towards services as opposed to services moving to PMIs.
Wow.
Services moving to manufacturing. And I think that that's going to happen in Europe as well, but it might not be until the early part of next year.
Jim, thank you, buddy. You're going to stick with us. Jim Karen, Monica Defend on the latest economic data as well. We'll talk about that in Europe in just a moment. Just bear that in mind, that in the United States, and in Europe for that matter as well, the theme has been that services have been up here, pretty decent data, manufacturing down here, pretty ugly. And a conversation we've been having, how do they converge? Services down to manufacturing or manufacturing up to services? Jay Pilowsky at TPW earlier this morning on Bloomberg Surveillance suggesting it's in the more constructive way. Manufacturing recovers, and you're hearing something similar from Jim Karen there. Your equity market right now on the S&P 500 positive by 0.7%. The opening bell about 20 minutes away. Down in Washington, some breaking news in the last, I would say, 5 or 10 minutes. I want to head down to Bloomberg's Anne-Marie to get those headlines for you. Anne-Marie, what's the latest?
What we know is Senator Mitch McConnell plans to stay on as the Senate Minority Leader to lead the Republicans on the Senate side. Jonathan, there's been a lot of speculation and concern regarding his health. Remember, he had a concussion. He was out for a few months. He came back, and then yesterday, while on camera, while speaking to reporters, having this press conference, he froze for 20 seconds, and he was lost for words, and he was escorted away. Then he did come back and address reporters, and then later when he spoke to reporters, he did a very political, interesting maneuver, turning it on the Democrats, saying their president of the United States also dealing with potentially some issues. He said, the president called me. I told him I was in great health, but that I got sandbagged. So what we're learning from CNN, Jonathan, is he plans to serve the rest of the 118th Congress as the GOP leader. The one thing that's interesting about this statement that CNN is publishing is that the statement does not address his plans in the next Congress, which begins in 2025. He is still going to be an elected official from Kentucky at that time, but the statement does not address his plans for 2025. So this is certainly one that we'll be watching.
MH, thank you. We'll be watching that through this morning as well. We'll touch base with you in about 30 minutes' time. The president addressing the United States on the economy and economic policy a little bit later on this afternoon. We'll get you a preview of that a little bit later. Equities then higher on both the S&P and on the Nasdaq with some movers. Here's Abby.
John, let's take a look at some of the upside movers helping futures climb this morning after yesterday's bit of a drop. Intel up the last time I looked up more than 6%. They put up a profit, 6.7%. They put up a profit instead of a loss in the last quarter, a 3% revenue beat. The biggest deal, though, is that they are saying the PC slump, the personal PC slump is over and the second half should be better, and they gave a bullish guide for the current quarter. Advanced Micro Devices up 1.7%. Now, they're a competitor, of course, to Intel. They report next Tuesday, but they're getting a little bit of a sympathy lift here. Plus, they did announce today that they're making a $400 million investment in India. And then finally, Reata Pharmaceuticals absolutely soaring, up 52%. Biopharma, the biopharma firm, is soaring on Biogen taking it over a bid at $7.3 billion. It will bolster its portfolio of treatments for neuromuscular and rare diseases. The share price, $172.50. The stock not so far below it, suggesting investors think it may get done.
Abby, thanks for that. We'll touch base with you around the opening bell. Coming up, more signs of economic divergence.
Inflation has been high everywhere, including US and Euro area, but really the primary drivers have been quite different. In the US, it's really coming from a very strong domestic economy. It's just more of a challenge in the Euro area to get us back to a steady state.
That conversation up next.
The near-term economic outlook for the euro area has deteriorated, owing largely to weaker domestic demand. High inflation and tighter financing conditions are dampening spending.
The broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures.
It is a tale of two recoveries, US inflation cooling and consumers remaining resilient, adding to momentum in the economy ahead of the third quarter. This as the data continues to raise concerns over in Europe. Germany just about exiting recession, but its outlook remains gloomy and manufacturing weak. Let's get to the team coverage. Bloomberg's Enda Curran in DC alongside Maria Tadeo in Brussels. Maria, how mixed are things in the Eurozone economy right now?
Well, they are, and that's a challenge for a central bank that obviously has to set monetary policy for 20 different economies. And I think you see that today in the data that we got from both Germany and France. These are the two biggest economies, so obviously we really look at them in detail. You had a huge beat from the French economy for Q2. You also had inflation, by the way, cooling down the most since the war started. When you look at the German situation, they're out of a technical recession at this point, but the outlook continues to be very, very difficult for this economy. A lot of this because of the industry and just this perfect storm that they've had for a year now. Also, I should also stress the data that we got today, and again, it points to this divergence perhaps between a more service economy and a more industrial economy. It is backwards looking. So we know that the European Central Bank will focus on the data from now until September. We also had a taste of it yesterday with Madame Lagarde saying there is an outlook that could probably deteriorate in the next few months. So that is really going to weigh in on this. So the data today, yes, to set the scene, but will it be crucial for the European Central Bank going into September? Probably not. They want to look into the future.
It's pretty mixed over in Europe right now. Ender, I have to say in the United States, it looks pretty robust, doesn't it?
Yeah, the US was supposed to be in recession by now, John. That was the narrative back in January. But as you know, the numbers keep coming in pretty well. GDP data yesterday showing pretty decent pace of growth for the economy. Underlying that, we know consumer spending is holding up. We know inflation is headed in the right direction. We saw some more detail on that this morning with the wages data showing increases just coming off moderately there. We know that investment in the manufacturing is going gangbusters. There are, of course, soft patches within manufacturing, but the electronic vehicle space and battery space and the whole industrial policy story is driving a lot of demand there. And so we know the US economy is in good order. That said, though, you know, there's a risk of getting too giddy about it in some respects as well, John, because the months ahead will tell just how far the labour market will soften. Will inflation continue to moderate the way the Fed is hoping, or will there be a bit of a sting in the tail as we get later into the year? I mean, it's fair to say that the soft landing story is very much the story of the day, but this inflation chapter isn't yet over, I think.
Something that Citi's Andrew Hollenhurst keeps talking about, Ender, repeatedly, that maybe the data over the next month or so might look like a soft landing, but the data later this year, he's expecting it to look a little bit different. Ender Karen there, Maria Tadeo on the latest. I've been talking about this over the last day or so, that what you heard from Chairman Powell and President Lagarde might sound the same, but the underlying economies are very, very different right now. Jim Karen, this came from Capital Economics moments ago. It said Q2 resilience unlikely to last, talking about Europe, but inflation is here to stay high. Now, Jim, why aren't we talking about stagflation in Europe when that's what increasingly it looks like?
I think that's the direction that we're headed in, effectively, right? So the ECB is in a very, very difficult position where they have some of the traditional economic data starting to fall, but inflation is staying sticky. And this is what I was referring to before, where there are different structural rigidities within Europe that are different than what's in the U.S. And I think a lot of it has to do with labor and the labor force. So the U.S. labor force tends to be a little bit more dynamic and robust. U.S. companies can upsize and downsize labor as needed relative to the economic cycle. In Europe, they have a lot more difficulty doing that. So as wage prices go up, that's like a form of permanence. If the economy starts to turn down, that starts to squeeze profit margins in companies, and this just becomes a lot more of a difficult situation for the European economy as a whole. So I do think that we are heading into some stagflationary pressures in the euro area. We also have to recognize that Europe is also tied a little bit more to China in terms of their economic activity versus the U.S. So those factors, the structural rigidities, the tied levels to China, are differences between the Eurozone economy and the U.S. economy.
Monica, Chairman Powell is hoping for a soft landing. Are there reasons to hope that President Lagarde doesn't end up in some kind of stagflationary quagmire?
Well, the U.S. economy has been extremely resilient and definitely well above our expectations. And even also the corporate earnings, despite variable, has been quite robust and resilient. And all the profit margin squeeze that we were expecting actually did not materialize, if not on specific sectors. So when it goes to our own projection, we expect the U.S. economy to slow down, mainly via tightening financing conditions. that have not been reflected fully yet in the real economy, but should eventually hamper the U.S. consumers that, as I was saying before, still with a positive sign, but real consumption is slowing down in the last over the second quarter, and the tighter financing conditions should also eventually hurt the small and medium enterprises. So overall, there will be a slowdown. How deep and when it will start to mark a recession that is still open. But the soft landing scenario is what we have in mind right now.
Jim, just to finish on Europe, if you end up in some kind of stagflationary state, how do bonds trade against that, Jim? Is that good or bad?
Well, I think it's more of a shape of the yield curve story. So what it tells you is that the curve probably stays relatively inverted, which is not good for the financial sector or the banks, because the ECB probably has to continue to hike rates, and that's going to put pressure on the front end. But then the markets are basically going to say, yeah, but eventually we're going to have a slowdown in a recession, and it's going to be a little bit longer lasting. So longer term bond yields end up staying relatively well bid and with lower yields. So you end up with an inverted yield curve, which is generally not a good economic indicator for the future. And that probably also, heightens some of the risk of a slowdown.
Hey, Jim, thank you. Jim Caron alongside Monica Defend there on the latest in this market. The central bank trilogy of the week, the BOJ, the ECB, the Federal Reserve. We need to talk about this equity market, up today by 0.7%. Coming up, the morning calls and later, New Edge Wealth's Cameron Dawson saying the market's AI obsession is starting to crack. The opportunities outside of big tech, that conversation about 7 minutes away. Minutes away from the opening bow. Look at that move on the Nasdaq. Futures up, up, up and away. Firmer here. Let's get you some morning calls. Deutsche Bank downgrading Southwest the hold, expecting limited upside following the airline's quarterly results. JP Morgan upgrading New York Community Bank to overweight, seeing an attractive risk reward with growing market share gains. That stock is up by 3.4%. And finally, Bank of America upgrading First Solar to buy, highlighting solid bookings momentum and the company's improving execution. That stock is up by almost 13% in early trading. Up next on this programme, New Edge Wealth's Cameron Dawson expecting the equity rally to start broadening out. The case for looking outside of big tech coming up very shortly. Your equity market positive by 0.66% on the S&P 500 and the Nasdaq 100 a whole lot higher. The opening bout just around the corner. Three seconds away from the opening bow this morning, this Friday, getting you towards the weekend. Your equity market positive by 0.7% on the S&P, on the Nasdaq up by more than 1%. About a week away, some big earnings from Apple and Amazon after some pretty big gains so far year to date. There's the opening bow this Friday morning. Good morning. Switch at the board and get to the bond market. Yields look like this on a 10-year, lower by a couple of basis points. Your 10-year this morning, 397.46. Yields higher yesterday off the back of better than expected economic data. And the rumour mill in full drive after that Nikkei report suggesting the BOJ would do exactly what it would do, which was tweak yield curve control. This morning, yields pulled back in the FX market. The euro trying to find some strength, just about 110 right now. Euro dollar positive 0.2%. Crude just short of 80, $79.60, down 50 cents on the session. We're down 0.6%. About 30 seconds into this session right now, your equity market more broadly on the S&P 500 advancing 0.7%. On the Nasdaq up by 1 percentage point. Two stocks to watch at the open, Exxon and Chevron. Shares under pressure after posting monster declines in quarterly profit. The Exxon CEO saying this: the work we've been doing to improve our profitability is reflected in our results, which doubled from what we earned just 5 years ago. Abby has more. Hey, Abby.
Well, John, their profit, though, is down 50% from a year ago. So I think that that's what's probably worrying investors to some degree. It's interesting, though, to see the shares of Chevron trading lower than Exxon, given the fact that they beat both top and bottom line estimates. Exxon did beat revenue estimates, but their profit, not only was it down 50% year over year, it missed slightly. So this is a margin problem. Both of these companies, or at least Exxon, is talking about the possibility, or not the possibility, the actuality of downstream or refining margin pressures, that it's costing more. Now, it's interesting because the conference call is going on, and one analyst asked the CFO about the upstream, could there be issues? And it sounds as though the fourth quarter, that some of the pricing pressure that we've seen recently, that really hasn't quite factored in. They're just starting to see that now. So will analysts be revising estimates down? It's completely unclear right now, but it sounds as though there could be possibly some issues ahead around that. But one bright spot, both of these companies, they're doing very well in the Permian Basin, John.
Abby, thank you. The latest on Exxon and Chevron down by 6 or 0.7%. Let's stick with results. Intel delivers a surprise profit and bullish forecast. The CEO says we continue to execute on our strategic priorities and building momentum with our businesses. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, well, Intel declared an end to the slump in personal computers demand, and actually it has the numbers to back it up. It was a beat and raise quarter for this chip maker. It posted a surprise profit, and it paired that with a bullish sales forecast that topped analyst estimates. Specifically, sales in the third quarter expected to come in as much as $13.9 billion. That compares to an average analyst estimate of about $13.3 billion, so higher than expectations. And Intel really needed this, given that the sluggish demands for PC chips up until this point, it really battered the business over the past year or so. And you add in CEO Pat Gelsinger's comments that Intel remains on track to meet its target of regaining manufacturing leadership by 2025. And you can see that shares currently up about 4% at this moment, had been higher by as much as 8% pre-market.
Katie, thanks for that. The stock is higher, as Katie indicated. Let's turn to Ford, pushing back plans to ramp up its EV production. The CEO, Jim Farley, telling analysts, clearly this transition to EVs is dynamic. The pricing pressure has dramatically increased in just the last 60 days. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. There's a lot of data to pass, but the story is pretty clear. The losses from EVs are deepening, and the timeline to ramping up production to higher volumes is getting more distant. So losses this year for the EV business will now be $4.5 billion US. They had previously said it would be $3 billion. Model E, the unit which manufactures the electric vehicles as a standalone business, had a loss of $1.08 billion in the quarter just gone. The other data point is that Ford's aim of an annual production of 600,000 units battery electric will not happen in 2023. They are now saying it will happen in 2024. So they're pushing that timeline out. Pricing is a really key point here. What Ford is saying is that the first wave of early adopters is gone. They have their EVs, and the average consumer is not willing to pay that higher price point. That's what the CFO, John Lawler, was talking about, them not seeing the top-line growth in electric vehicles that perhaps they'd expected. So what do we see? Well, a lot of price pressure, and a lot of the intensity of that price pressure, according to Jim Farley, the CEO, has come in just the last 60 days, cutting prices to be more competitive against Tesla. Interestingly, though, the broader business is quite healthy, and this was the headline immediately after the market closed when the numbers dropped. They raised guidance for adjusted EBIT this year higher because, of course, they still have the legacy combustion engine business, and there is demand there and performance there as well.
Did we hear the same thing from GM?
Yeah, it's interesting. You look at the sell-side reaction to Ford, and they said the bar for Ford going into this was so high because of the results that GM posted. But both of them are in the same boat, right? Transitioning the business from a combustion engine to EV, selling both, but also having to cut prices to basically target what is the remaining demand. The early adopters are gone. The average American or global consumer doesn't want to pay $75,000 for a car.
That stock's down by 3%. Let's push ahead to next week. I know you're covering earnings from the likes of the big tech players, Apple, Amazon as well. What are you looking for from those names next week?
Well, I'm also kind of smiling at relief that they're not all on the same day this quarter, because that can be brutal for me. But I think that we basically want to use them as a proxy for the consumer. You know, Prime Day for Amazon is always a bit of a misleading indicator because they always break their own record. But it doesn't give you a good sense of the health of that business. Also, cloud gives you the barometer for corporate demand and corporate spending. AI is a big part of that story. Apple, maybe we get some early indication of the Vision Pro, but it's all about the iPhone globally and some sense of what the global consumer is doing with a microscope on China, John.
Ed, if you had to grade it so far, looking at Meta, looking at Alphabet, it's been a pretty good week, hasn't it?
Been a pretty good week, but read Alex Barinka's Tech Daily newsletter. AI is all the hype we're talking about. You actually look at the reaction on the sell side, some of the buying. I think that actually there's still a lot of faith in the fundamentals of these businesses. Strong balance sheets, demand for their product or services, even in a weaker economic environment. They have staying power because of what they're able to offer and their global reach.
Looking forward to the show a little bit later, 12 Eastern Time. Ed Ludlow alongside Caroline Hyde on Bloomberg Technology. Let's turn back to the market. Big tech leading stocks towards a third consecutive week of gains. Our next guest, though, says it could be the laggards that start leading the way. New Edge Wealth's Cameron Dawson saying this: we're seeing the everything else rally. Better economic growth should mean broader participation, especially from the economically sensitive sectors that have been left behind. I'm pleased to say that Cameron Dawson joins us now. So, Cameron, let's start there. What has been left behind?
Yeah, what we've seen this year is, of course, that really narrow leadership within tech. And what you've seen is that there's been laggards in economically sensitive parts of the market. So things like energy, industrials to start the year. But really, since June, you've started to see some of those areas perk up as economic data continue to come in better than expected. So if we are to see this more resilient economic data, we would expect broader participation in the equity rally, meaning that those areas that are cyclically sensitive should start to do better. And it also is important to point out that these are the areas that have seen the least amount of PE expansion or multiple expansion. So there's more room for those multiples to adjust to a better economic reality compared to the technology stocks and growth stocks that have already re-rated back up to their 2021 peaks.
As you indicated, the economic data has improved. Cameron, any evidence that earnings estimates have gone along with it?
This has been really peculiar this quarter, is that we continue to see economic data come in better than expected. We see it with economic surprises. We see companies beat and raise estimates. And yet, if you look at the full year estimate for 2023 earnings, they have inched down just slightly, which means that analysts are effectively cutting numbers for the back half of the year. So that does create a scenario where we have a low bar for earnings in the back half of 2023. But then we'd know is that what that also creates is even more growth expected in 2024. You have about 11-12% growth already baked in for 2024. And a lot of that is margin expansion, which would bring you back to peak margins that we saw back in 2021. So that's one area where we would watch that maybe estimates are a little bit too high. But in the near term, it does seem that estimates are too low for the economic reality.
Just on pricing power, just briefly, Kimberly-Clark, Procter & Gamble, volumes dropping off, but revenue growth because prices are able to increase and the tolerance still seems to be there. Do you expect that consumer price tolerance to last much longer?
Well, it is a really good question because as we continue to see kind of stronger goods demand as well, look at the personal consumption data today. Instead of it being led by services, it was actually led by goods. Goods were much stronger than services, even despite this turn in higher prices. So for now, consumers are accepting it. We're seeing a little bit of give back on volume, but Procter & Gamble this morning raised prices by 9% and only had volumes drop by 3%. That's pretty incredible and is a key reason why margins have been so resilient for these businesses and why revenue growth has remained so strong.
About 10 minutes into the session, the Nasdaq outperforming. We're advancing here by 1.2% on the Nasdaq. If you are just tuning in, the S&P 500 higher by 0.75%. Cameron, I remember a note that you put out in the last couple of weeks, and it was bull, bear, or duck. For the people that haven't read that, haven't heard you talk about it, what is a duck?
A duck is a market that goes sideways, but there's a lot of activity happening under the surface, meaning that if we do see this rotation away from some of the leaders this year, this idea that maybe tech digests some of its recent gains as it hits that peak in valuation, but you do see a recovery in some of these areas that have been left behind, those rotations under the surface could mean that there's lots of opportunity for price changes, but the overall index doesn't move very far, just meaning that we've kind of hit a ceiling on broader valuation, but there's still lots of room for rotation underneath, which is one of the ways that we've been playing this market since the beginning of June, buying equal weight, looking for areas that are trading at discounts in order to take advantage of the rotation. So a duck market seems smooth on the surface, but lots of activity underneath.
Where do the small caps fit into that?
Small caps are still extraordinarily sensitive to interest rates. I think that this is one of the key headwinds for small caps is that they are less profitable. You still have about 45% of companies within the small cap Russell 2000 index still not turning a profit, even in this economic environment. And they tend to have more floating rate debt, which just means that higher interest rates actually bite small caps compared to large cap companies, which have had the opportunity to term out their debt, essentially make them agnostic to current interest rate levels, and really being able to be resilient even in an economy where you see the Fed raising rates so much. So our view on small caps is that you see these pockets and spikes of recovery, but you're unlikely to see a sustained rally and sustained period of outperformance until we start the next cycle, which just means that small caps typically do best at the beginning of an economic cycle when the Fed is easing policy rapidly and they're kind of rebounding from that near death as you went into the recession. So small caps, we think you still have to remain very high quality simply because of high interest rates and that economic sensitivity.
Hey, Cameron, thanks for that. Enjoy the weekend. Let's catch up soon. Cameron Dawson there of New Edge on the latest. Thank you. The broader market about 12 minutes into the session advancing by 0.8% on the S&P. Nice, pretty decent outperformance on the Nasdaq going into a big week for the Nasdaq 100. Some big weightings there for you. Apple and Amazon next Thursday. Up next on this programme, the president promoting his economic agenda ahead of next week's jobs report.
There are two parts of Bidenomics. The first part is just explaining what's going on and claiming credit for what is a pretty strong economy, inflation aside, and that's a big aside. The second part about Bidenomics is to talk about some of the president's legislative achievements.
The president heading to Maine to discuss Bidenomics. That conversation up next. We'll catch up with Anne-Marie and Mike McKee.
There are two parts of Bidenomics. The first part is just explaining what's going on and claiming credit for what is a pretty strong economy, inflation aside, and that's a big aside. The second part about Bidenomics is to talk about some of the president's legislative achievements, which collectively amount to this big pro-growth agenda that he got through a divided Congress. So it's both about claiming credit and then explaining sort of the rationale for all the legislations.
Everything's been amazing, inflation aside, as he said. That's a big aside. President Biden preparing to discuss his economic agenda following a string of better-than-expected data. The White House saying this. The president will discuss how Bidenomics is driving a manufacturing boom and helping workers and innovators invent and make more in America. Bloomberg's Anne-Marie has more. Hey, Anne-Marie.
Hey, John. Well, today you can expect a fresh installment of Bidenomics with a focus, as you mentioned, on manufacturing. For the first time in his presidency, the Biden will be heading to Maine. He'll be giving this speech on manufacturing at a factory, and his message is going to be behind those strong economic data points is that his plans are working. One of those points he's likely going to mention today is that investment in manufacturing construction has had its single largest contribution to the nation's economic growth in more than 4 decades. The issue the president is facing, Jonathan, and we talk about this a lot, and actually our reporting is that he's been frustrated with aides around him, is that the message is not landing. The American people are still not feeling that the economy around them, even if the data is showing that it is doing better, that it actually is doing better. They can't feel it. So that's the message the president wants to bring to Maine today. Another interesting point, Jonathan, about this factory, it recently won a legal battle with a Chinese competitor. So broadly, Biden is also potentially going to talk about competition with China and how that plays into his larger economic plan.
Any sign that's resonating with voters, Anne-Marie?
Well, I'm not sure that's resonating with voters at the moment because we're here from both sides of the aisle that everyone wants to talk tough on China, right, Jonathan? So I think voters get it from all sides when it comes to China. I think it's really going to come down to how people feel about their household income, about their disposable income, about their job and growth prospects when it comes down to November in 2024. I think they're less focused on competition with China and more focused on how much am I paying for groceries and what's the gasoline price today.
And that gasoline price is going the wrong way all over again, more recently anyway.
Yeah.
Anne-Marie, thank you. AMH down in Washington, D.C. That address by the President, 1:15 Eastern Time. If you want to pay some attention to that, we will be here at Bloomberg. Looking ahead to next week, a payrolls report just around the corner. Mike McKee back with us for more. Mike, what can we expect?
Well, it's going to be a very busy week, Jonathan. It's the first week of the month, and that's always the week we get the big numbers. We start off with one last day of July, and we get the Senior Loan Officer Survey on Monday. Remember that? The Fed chairman talked about it. He said it's going to come in as expected, so we think there'll be some tightening there. Tuesday, you've got ISM manufacturing and JOLTS. Wednesday's ADP. Thursday, productivity, jobless claims, ISM services, and then Friday is Jobs Day. And in terms of the Jobs Day numbers, we are expecting a slowdown. We've been expecting a slowdown for months and months and months, and it doesn't seem to happen. 190,000 jobs is the forecast at the moment. That'll change as we go through these numbers next week, and economists get a better view of what's happening. But unemployment not supposed to go up, and average hourly earnings supposed to go down just a little bit. So if Joe Biden were giving this speech and we got these numbers a week from now, he'd still have some good news to talk about, and we'll see if that is indeed the case.
I imagine he won't be talking about the ISM Services Index, Mike. Wall Street will be. There is a survey of services activity next week. Mike, Jim Karen of Morgan Stanley was on the programme earlier this morning, and he was talking about that divergence, the divide that we talk about, you and I, between manufacturing and services, and he thinks the manufacturing can converge up to services. What are you seeing more recently in those surveys?
Well, what we saw last week or earlier this week, the S&P PMIs, manufacturing did improve a little bit. Services did decline a little bit, but services are still above 50. So if manufacturing moves up to where services are in the ISM version of these PMIs, then it's going to be good news for the economy. And I think we pointed out earlier on the show that goods spending was faster than services spending in the month of June. So maybe things are turning around a little bit.
Very little sign of Fed speak on the calendar, Mike. Have you noticed that?
It's just beginning to fill in. We're going to hear on Monday from Raphael Bostic and later in the week from Tom Barkin. And so I imagine it will pick up, but they're all going to go on vacation. Wait till Jackson Hole. That's when we'll
That's
hear
what we
from
should
a
do,
lot
Mike. We'll take a month off and we'll reconvene.
I'd like that.
Jackson Hole,
you'd
I'd love
talk
that
to the
too.
boss about that.
I'd love that too. TK's going to cover. Tom's very adamant about the American philosophy of work and no vacation, so TK's going to be here, taking over things. Mike McKee, thank you. Looking ahead to the Senior Loan Officer Opinion Survey, SLOOS, a sign of its time, really, in many ways. It's like the inflation hysteria of the last couple of years. Hysteria because it was legitimate. Let's be clear about that. But also the fact we were looking at Mitch, inflation expectations during that time, and now we're not really. And the Senior Loan Officer Opinion Survey, well, that was all about the bank intention of 2-3 months ago, and now hardly anyone's paying attention to it. It comes out, as Mike indicated, on Monday, by the way. Let's get you some sector price action. We can do that with Abby.
John, we have a very robust day for the S&P 500, the best in basically a month. So not surprisingly, most sectors are higher, led, in fact, by the heavyweight tech sectors, communication services, consumer discretionary, information technology, all up more than 1%. We also have staples, a defensive sector, interestingly enough, up more than 1%. To the downside, energy and healthcare. Energy, of course, dragged on by Chevron and Exxon. As for the week, well, it's going to depend on today. Basically, what today does will determine the S&P 500's direction. So right now, we are looking at a gain. The best sector right there, the communication services index, up 6.5%. Its best week since March 17th, of course, on Alphabet and Meta and those blowout results and the stocks reacting to the upside.
Appy, thank you. Advancing again this morning. Your trading diary up next. the sun is shining on this economy, this market right now, that's for sure. The data's been decent, the earnings have been okay. Chairman Powell appears to give the impression that he's willing to back away. And equities are up by another 0.8% on the S&P. The Nasdaq's positive by 1.5%. Next week, huge week for earnings. We'll talk about that in just a moment. That's the price action. Let's get to the trading diary. President Biden promoting his economic agenda from Maine this afternoon at 1:15 Eastern Time. Then we get ISM manufacturing numbers next Tuesday. More tech earnings from Qualcomm on Wednesday, Apple and Amazon earning results on Thursday, plus ISM services and a Bank of England rate decision coming up a little bit later next week too. And finally, the US payrolls report this time next week on Friday. From New York City, that does it for me. Enjoy the weekend. This was the Countdown to the Open. Good luck for the rest of the trading day. This is Bloomberg.